My big thing here is, you cannot be the perfect shop owner. You cannot maximize the performance of your shop, no matter how many locations you have, if you don't understand the finances.
Well, welcome to the Lift Your Shop podcast today. We have another amazing guest this week in Hunt Demarest of the Paar, Melis and Associates company. And today we're going to be focusing a lot on the financial aspect of your auto repair shop in terms of the P&L, metrics, and everything like that. But Hunt, if you wouldn't mind introducing yourself a little bit to the audience and kind of explaining your background, how you kind of got started in this.
Yeah, appreciate it. My name's Hunt Demarest. I'm a CPA here with Paar, Melis and Associates. My firm specializes in automotive repair shops. So we work with about 600 shops on a monthly basis all across the country, helping shops with obviously the easy stuff on accounting, tax, payroll, but then also helping them people understand more about their finances. I always tell people that financials are only as good as what you understand, and being able to set those up in a clean, effective way that you can use to make decisions off of is really our biggest job and our biggest goal here.
That's super awesome. I love that because if you're not understanding your numbers, I mean, you're kind of lost in the business. You're kind of shooting blind a lot of the time. Mm-hmm. So that kind of just leads us into the P&L. And so obviously we know that, I mean, based on your experience of all the different shops that you've helped on the financial side, there's going to be good ones and then there's going to be bad ones.
Or non-existent ones too, right?
Yeah, exactly. So I guess in terms of the ones that then start up, like with you guys, I'm sure that they're starting with you guys for a reason. So what are some of the common problems or misunderstandings that you're seeing with those that you can kind of help enlighten us on?
Yeah, I would say that the biggest thing that I see with people is, really two big things. The first one is a lot of people are really intimidated by QuickBooks. Oh, I can't do that, right? I've tried it. I just gave it to someone else. I have a bookkeeper. I have an accountant doing it. I just can't understand that. And QuickBooks Online is a very easy to use piece of software. And I tell shop owners this all the time. If you can use TechMetric, if you can use Shopware, you can use QuickBooks. QuickBooks is much easier to use than that. But a lot of people get off on the wrong foot, right? The chart of accounts was never set up correctly. Or maybe you know how to do it now, but there's so much old junk in there that it's really super confusing. And of course, it doesn't make sense for you. And so being able to get the chart of accounts into QuickBooks set up correctly one time, and then also kind of a crash course on, hey, what should I be doing is very, very important. On the financial side of things, the biggest thing that I see is a lot of people say, Hunt, I don't understand my financials. And I look at their financials and I say, well, Kelsey, it shouldn't make any sense to you, right? I see thousands and thousands of financial statements and I can barely make sense of it because it's not set up correctly. There's wrong information on there and it's altogether just junk, right? And so the really important piece there is getting these people the proper training that they need so that they're comfortable with QuickBooks. Once you're comfortable with QuickBooks, you're going to be able to learn even more, right? You're going to be able to go beyond the surface level stuff. And then again, if you are working in there and you have this stuff set up correctly, now the stuff starts to make sense, right? Now you can see, all right, this is how it translates onto paper. This is why Hunt said I have a productivity issue and he's never seen my shop because it sticks out like a sore thumb on the financials if they're set up correctly. So making sure that you have that foundation there is key for anyone that's trying to understand this.
Awesome. Yeah. So I guess to take a step back, you mentioned chart of accounts is sort of a key word. So what does that mean in terms of chart of accounts?
So chart of accounts, and I'm going to specifically be talking really on the profit and loss side of things. Chart of accounts, for the most part, people have pretty good on the balance sheet, right? On the balance sheet, it's going to be your bank accounts, you got your assets, and you got your loans and liabilities. Now, there could be some bad balances in there, but generally the chart of accounts is pretty sound. On the profit and loss side of things, I usually see one or two extremes. I see one extreme, which is actually a bad thing, is having way too much information on there. I see people whose, collapsed profit and loss statement is 3 pages long. And what I want that profit and loss statement to be is to be able as a good, quick look at what my business is doing. If I need to dive into more detail, I can go into the sub accounts and go into the details of those transactions. But I want that to be a 1-2 page report that's got all the key information on there. So sometimes we see those where it's just overly complicated. I'm saying, Kelsey, all the information is here. It's good information, but I need to clean this up. I need to consolidate this so that it actually makes more sense, right? A great example of less is more.
Yes.
The other end of the spectrum is the people that don't have any information on there, right? That their financial statements is like a half a page long. They have all their sales going into one account. They have their parts purchases, and then they have one account for all their payroll, a couple other operating expenses. But again, if I look at that, it's going to be a good indicator on sales and net profit. Gross profit, everything else like that, who knows? Because it doesn't give us enough information. The sweet spot is really somewhere in between there. And, depending on who you work with, what coaching company, how your brain works, everyone has a little bit different chart of accounts. We have kind of a standard one that we use for most, but there's a couple areas where I'll say, Kelsey, what makes sense for you? Because like I talked about, I can look at these no matter how it's set up. I want this to click to my clients, to my shop owners and say, all right, does this make sense to you? Because if it doesn't, then it's worthless. But general situation is in my sales and my cost of goods sold account, I want that to be mimicked very similar to what my shop management software is doing, right? And so instead of having sales be just one lump deposit, or maybe you're doing cash and checks, I want my sales to look like labor, parts, shop supplies, sublet. I want it to be able to match exactly to what my shop management software is saying. And then on the cost of goods sold side, anything that I'm tracking specifically on sales, I want to see a corresponding cost of goods sold. Parts cost, labor cost, shop supplies, sublet. I want to be able to match those and measure the gross profit on all of those. And then the last piece of it is your fixed expenses. So pretty much anything that's not directly related to selling is our overhead, is our fixed expenses. Depending on how in depth that you want to get on the fixed expenses, it's going to kind of dictate how that chart of account looks. My big thing though is if you have an account and you're sitting here looking at it right now in May, and there's $300 in that fixed expense or overhead account, consolidate that with something else, right? It's just not enough that you really need to look at it separately. Like if you have postage in there, right? You have an expense for postage and there's $36 in there. Get rid of it. Just put it under office supplies, right? It's just creating static. It's creating noise with no real value.
Yeah, and I love that. And so I guess do you maybe have a rule of thumb or a range of an amount of chart of accounts that someone should have, maybe in each section of the P&L, that then you're like, this is a good amount. Maybe it's 15, maybe it's 20, maybe it's more. What does that typically look like that you've seen?
Yeah, so the sales and the cost of goods sold side are a little bit different story than fixed expenses. So what I always say on sales is, we have 5 key areas that we usually do, right? The standard: labor, parts, shop supplies, sublet. And then if you sell a lot of tires, I want to split tires out as well, because that's obviously a different gross profit margin. But the thing about it is I don't want to track the sales separately unless I can track the cost of goods sold separately, right? Because like a big question I get asked is, well, hey, hon, I want to track battery sales. I want to pull that out of parts and track batteries. And I say, well, do you get your batteries from a different vendor? No, it all comes from the same one. All right, well, is there a way for you to quantify and pull that cost out? Not really, because it's all just in one bill. All right, then I don't want to track it because I'm going to have $1,000 in battery sales, 0 cost, and I know darn well that I'm not making 100% on batteries. Yeah. Right. And so similar to the fixed expenses, if it's not a material amount, then I'm not worried about it. Right. If you're doing $100,000 in sales a month and you do $1,000 in tire sales, I probably wouldn't even worry about splitting out tires. It's such a small amount that's going to be built into your parts margin anyways. Don't worry about it, right? You're missing the point of the financials. We're not looking for these pennies here. We're looking for something that makes a major difference. As far as the fixed expense and the overhead, I can't give an answer on the actual numbers of it. But if you look at your profit and loss statement, it's going to stick out like a sore thumb because you're going to see 8,000, 6,000, 4,100, 10,000, 40,000, $15, right? And so just look at it and say, hey, do I analyze that? Is this material enough for me to be worried about? Or can I consolidate this and actually clean this stuff up a lot?
Oh, I love that. That's, cleanliness really allows you to read a P&L so much better when you really understand like what is going in there. So even if you're hiring it out, you're not doing it yourself. Making sure that you understand some key metrics to be able to decipher and make decisions is really important. Because at the end of the day, you're not able to make decisions off of what you're seeing. What is the point? Yeah. So I guess in terms of those key decision makers, those KPIs that you're seeing in a P&L, what would you recommend for auto repair shop owners to understand when they're looking at it?
So the big thing is, first and foremost, we need to understand gross profit. Gross profit's the number one driver of businesses. If you do your gross profit well, you can screw up everything else and you're still going to make money, right? And when it comes to gross profit, for most people, that's parts and labor. Again, you could do really well on sublet, do really well on tires, do really well on shop supplies. It's just not a majority of your sales. If you do parts and you do labor well, you're going to make money on it. So for the labor, the way we usually look at labor and judge labor is two ways. So we look at your overall gross profit, meaning sales less your direct cost divided by your sales. That gives you your gross profit. So if I have $100,000 in labor sales, I pay out $40,000 to technicians. I'm now left with $60,000 of gross profit, or 60%. 60% gross profit is a target that we shoot for loaded costs of technician labor. And then for parts margin, generally that's around 50% gross profit. If you can average 60% for labor, 50% for parts for a general repair shop, you're going to do pretty well. Now, the other thing on labor that people need to understand as well, which I think is a really big indicator on success or future success, is productivity, right? And so if you have a technician there and you're paying him hourly and he gets you 20 hours a week in billable hours, you're paying him 2 hours for every 1 hour he's getting you paid. And that is one thing that I see a lot, where you can still be making money, but unless you're maximizing not only your markup, but also your productivity, that's severely going to affect your gross profit and ultimately your net profit.
Awesome. That was some great tidbit. So again, like for those listening and watching, the gross profit was 60% for labor, 50% per part. So I guess how like I'm sure that's through analyzing a bunch of different shops, but how did you come about creating those as kind of the rubric for success in terms of like a benchmark or percentage wise?
Yeah, and so we've been doing this for a long time, right? And so some of these numbers have been created by other people. We measure this stuff, and really, I learn a lot still from the shops, right? And so I look at successful shops and I say, what is setting them apart, right? What is the top 10% doing that the bottom 10% aren't? And also being able to look and say, hey, what's realistic? Obviously, I'd want 90% gross profit, but I don't see 90% gross profit, right? Now, is it realistic for someone to have 70% gross profit on labor or even above? Yeah, but it's very rare. And usually there is such thing as having too good of gross profit, actually. So if I see someone that has 75% labor gross profit, I'm happy because we're making a bunch of money, but I'm saying, you know what? The numbers are telling me you guys are maxed out and possibly even overworked right now. If you're at 75% gross profit, you're killing productivity, efficiency, and pricing. You're not going to be able to drive your sales another 20%. You just physically don't have the workforce to do it, right? But then the same flip side, if I have someone that's at 45% gross profit and they say, Hunt, I can't do any better than that, I'll show you 5 different shops that are doing it right now, right? And so doing actual, real life of like, hey, it's great to say, hey, you should be able to do this, but it's also, hey, I've seen it. If you don't think it's possible, I'll put you in touch with someone that's doing it right now. Now, the labor and the parts both fluctuate based on what you're doing. So depending on how your shop's set up, what size it is, and all of the above, it's going to dictate kind of what both those numbers are. The labor one's a little bit trickier because that one's usually a little bit more standard, but I have super high volume shops that don't quite hit 60%. Maybe they run into 50% and they still make very good money. They have a lot of non-production people in the labor, not customer service, but quality control people, foremans, and stuff like that, porters. On the part side of things, if you're a general repair shop, 60% gross profit on parts is not unheard of, and a lot of people hit that number. If you're doing Euro, exotic, stuff like that, you're probably never going to be able to sniff that, right? Most of the stuff is coming from a dealer part. Also, as the parts costs get higher, you can't make as much money on it, right? So if we have a $60 Honda water pump, marking that to $120 is pretty reasonable, and people do it all day, every day. If we're comparing that to a BMW electric water pump, which retails for around $450, a little bit harder to charge that out for $900, right? And so what I always tell people is these are good industry statistics. These are good industry numbers. Don't beat yourself up too much. And another thing too that I also like to kind of remind people is, hey, even if you're at 40% right now, whether it's parts, labor, even overall gross profit, If you want to go to 60%, this stuff doesn't happen overnight,
Mm.
right? And so a lot of what I'm doing with numbers is looking at trends. All right, Kelsey, where were you last quarter? Where were you last month? Where were you last year? And what I'm looking for is consistent improvement, right? All right, we're at 42% last quarter. Hey, we're at 44%. Hey, we're at 45%. I want to see that maintaining or moving in a positive direction. Now, one of the other things that we're looking at there too is, all right, are things starting to slide, right? Hey, we were at 46% last quarter. Now we're down to 44%, 42%. And I think that that's a really important topic in today's market, because what ends up happening is people get really busy. And a lot of shops, and you can probably, back this up, a lot of shops right now have more work than they know what to do with. Mm-hmm. But what happens is if you have more work than you know what to do with, stuff starts to get a little bit sloppy, right? Hey, that car needs to just go out the door. Just get it done, get it done, get it done. Parts don't go on an invoice. We start missing parts. We start decreasing stuff. And then inevitably what happens is now you just did 20% more in sales and you didn't make any money, or you made the same amount of money as you did the previous month. Uh-huh. So maintaining those profits, and you can't maintain them if you don't understand what they are.
Yeah, absolutely. And that's perfect. And gross profit, definitely probably the most important KPI metric. So thank you for elaborating on that. Are there any other kind of big KPI metrics within the P&L that you highly recommend other shop owners understanding?
So the big thing here is when I look at it, and kind of going back to what I was talking about before of the use of the financial statements, is sometimes people have too much of a micro point of view. Yep. They're just pulling out individual numbers here and there. And depending on what you look at, you can kind of steer yourself in the wrong direction. And so what I usually like to do is I like to take kind of a higher level look at it. And I want to kind of analyze our pain points here. So the general model of a repair shop is I'm including service advisor and cost of goods sold, but I want to see 50% gross profit. I want to see my fixed expenses be 30% or less of my sales, which now leaves me with 20% net income, right? So if I have $100 in sales go through, $50 go into my techs, my parts, my shop supplies, my service advisor. Now I still have $50 left over. $30 of that is going to pay my advertising, my insurance, my rent, any admin staff, and my own payroll. And then that's leaving me with $20,000 in net income. So I usually use that as kind of a good baseline when I'm judging a business. And I want to see, all right, is it a fixed expense issue? Is it a gross profit issue? And so if you're doing $80,000 in sales and your gross profit is $40,000, we're at 50% gross profit, right? We're profitable on what we have. Now, if we look at our fixed expenses and our fixed expenses are $40,000, we're not making any money. Yep. The pricing is okay there. Now, here's a tricky one, because a lot of people, when you would look at that, conventional logic is, all right, our fixed expenses are too high. I need to start cutting fixed expenses. And I'm not big on budgeting fixed expenses, because realistically for most shops, that's just what it takes to run your business. Mm-hmm. Who am I to come in and say, you know what, you need to cut this, you need to cut that, you need to cut that. Now, if you're frivolously spending and you're doing stuff like that, then sure, it's a good exercise. But if you have something where it's looking like your fixed expenses are too high, what that's really saying is those are too high relative to the sales that you're doing right now. Mm-hmm. If you have that same exact business doing $80,000 and you now take it to $120,000, those fixed expenses are more or less still going to be $40,000. But now the percentages start to make sense. And so looking at it that way, that will allow me to take a look and say, hey, where do we start here? Right? So for that exercise of 50% gross profit and $40,000 of fixed expenses, I'd be looking at this and saying, hey, Kelsey, we need to boost the sales. Hey, you're pricing this stuff well. You're doing all right on the front end. We just need to feed more work through this machine and it's going to make us money. Mm-hmm. Right? If we had another example where it's saying, hey, we had $100,000 in sales, $30,000 in gross profit, $30,000 in expenses, then we're saying, all right, the sales are there. We're just not pricing this stuff effectively. We're not getting the proper markup, or maybe we're not productive or efficient here. Fixed expenses are perfectly good. We need to fix our pricing first. Those are usually one of those two things is probably the path that your shop needs to go on, or that maybe you've overcome and already kind of, had to tackle yourself.
Yeah, no, I love that. I mean, just kind of simplifying it for everyone in terms of gross profit margin, fixed expense percentage. net income, like you mentioned, was 20%, correct? Net
Yep.
income, 20% should be what you're shooting for. So then, so with that net income, now that people have that coming in after paying themselves, now the question I hear is like, now what do I do with it? Do I put it back into the business? Like what, like, am I allowed to take it out? Like what does that look like?
Yeah. So it depends on what type of business that you are, right? Most of our clients are C corporations. I mean, not C corporation. Most of our clients are S
Yeah.
corporations. If you're an S corporation, whatever money your business makes, you're free to take out in the form of the distribution, right?
Mm-hmm.
If you're a C corporation, you cannot do that. C corporation, you can only pay yourself payroll, rent, or dividends. Most people don't do dividends because you get taxed both sides of it.
Yeah.
But if you're an S corporation, you made that money. It's in your business bank account. You are your business. The business is you. You're free to take that money out. Now, what you want to do here, and I've seen this happen a lot, is you don't want to personally strap the business. I want a distribution to be a one-way street. And when I mean one-way street, it means, hey, if I take $20,000 out of my business is still healthy enough, not only to operate on a normal basis, but also to withstand some downturn. And I can truly think or spend that personally as much as I want or on whatever I want. So what I usually tell people is I want to see 3 to 6 months of operating expenses in my business, right? So if you have $30,000 of monthly operating expenses, which is essentially your overhead or your fixed expense,
mm-hmm.
then I want to see $90,000 to $180,000 in that business, right? Mm-hmm. So let's say you come up and split in the difference and say, all right, I'm going to have $150,000 in my business at all times. I'm looking at that periodically throughout the year. And so what that would look like is, let's say we're sitting here now in May. I would take a look at that at the end of May and say, all right, I have $180,000 in my business bank account. I know 150 is that baseline that I want to keep in there. I can now take 30,000 out, and I know that I'm still going to be safe in my business.
Nice. Yeah, I like that. Because even for me, when running my business at the time, like, wait, what am I allowed to take out? What's okay to do? But it's good setting forth a baseline of what should be in there, so anything up and above can be taken out. And so I know a lot of people also love profit first, and then the book and the principles that are applied there. So I guess, what is your take on it? Are those effective principles to apply, or maybe are there some kind of customizations that should be made for an auto repair shop owner? Mm-hmm. Why don't we go from there?
Cool. So profit first, yes and no. Am I a fan of it? Somewhat. I have kind of a weird story about profit first themselves, and we tried to do a webinar one time on it, and they threatened me because I wasn't allowed to talk about it. The guy I had on wasn't allowed to threaten it, but it's worked for a lot of my clients. We've been preaching before profit first came out. I should turn around and sue this guy because he stole our idea. Every business should have at least 3 bank accounts right now, mm-hmm. right? So you should have a checking account, a savings account, and then usually at least one other account that you're using at the very least for your sales tax, right? And so I've always preached that, hey, if your sales tax is 6%, every single week, take that sales tax out of your operating account, put it into your sales tax account, so you know that that's always going to be set aside. Mm-hmm. The sales tax, depending on what state you're in, is always paid quarterly or monthly. And a lot of people, especially if business gets slow, when it comes to pay the previous month, they've already spent that money. And this is to kind of avoid that. And again, the savings account is there because we need to set some money aside. Hey, every single week, take out $100, take out $500, take out 2%. And what I always tell people is just make it like a bill. Hey, every single week I owe $100 to my savings account, and I'm going to start pulling that money out because we want to build up the reserves there. Now, if you go to full on profit first, you're going to have upwards of 6, 8, I have clients that have 10 different accounts. And what that allows people to do is it allows people to budget their money a lot more effectively. Mm-hmm. And my big thing is it doesn't work for everyone, and it's not necessary for everyone. Yeah. Profit first is not necessarily going to make you more money. Profit first is going to allow you to run your business and spend money in a lot more educated way versus an emotional. What I see a lot is people making decisions based on what their bank account says. Hey, I got $80,000 in my bank account. Yeah, I'm going to go and buy that piece of equipment. I'm going to go pay bonuses. I'm going to do that. But if they had $10,000 in that, they would say, no, the sky is falling. I can't afford that.
Yeah.
Profit first kind of allows them to say, hey, you know what? Of that 80,000, 20,000 is owed to Napa. So that's not really mine to spend.
Mm-hmm.
10,000 of that is saving up for my end of year taxes. $15,000 of that is this week's payroll. And then what that would do is instead of having $80,000 in your operating account, you look at that and you're saying, hey, I really only have about 15,000 I truly can spend. Now you can kind of stay within your constraints and not overspend on it. So the big thing on it is if profit first makes sense, if you feel like the cash management is something that you struggle with, try it. Just don't go overboard on it, because a lot of people, they try to go full in on it and they try to set up 10, 12 different accounts, and then they give up because it is a decent amount of legwork with the transfers and stuff like that. What I always tell people is probably somewhere in the middle, right? Get 3, 4, 5 different accounts and budget it accordingly, depending on what your goals are.
Yeah, absolutely. I think that ties right into the fact in the beginning where we talked about the chart of accounts and having too much can be a bad thing. I think the same thing with your bank accounts. I mean, if you have too many, you get overwhelmed, you give up. And so you want to keep it simple where you understand where certain things are going, especially taxes. I think that's a great sales tax being separated. I think that's something quickly forgotten by people where they think they have more money than they actually do. Because I mean, you don't pay your sales tax, then they'll come a knocking. So
they'll chain your door shut. Yeah, I have a client that actually spent some time in jail for missing some sales tax payments. Man, everyone gets nervous about the IRS. The IRS can get nasty. Sales tax is number one, the biggest thing that we see, and about 100 times more common than an IRS audit.
Yeah, and so I guess in terms on top of just outside of sales tax, what are some? Is it just going to be basic income tax that people should be worried about? How much should they be saving? Mm-hmm. Are there ways that they can save on having a lower taxes? Like what does that look like?
Yeah, so you always want to be setting money aside, right? And so general rule of thumb is whatever your net income is, you're probably going to owe about 20% of that to Uncle Sam, and so if you want to look at that and be kind of a good indicator of where you're standing on things to make sure that you have money set aside, you can do it that way. I have some people that, if you do the math, if you're making 20% net income, then that means 5% of your sales is going to end up being tax. People budget it that way. As a general rule of thumb, though, you shouldn't be burning through that much cash anyways, right? Especially in times like this, I feel like that people have a very short-term memory of what happened just 2 years ago when our lives were flipped on top of our head and, everything shut down. Cash is king, right? Cash is king. We need to make sure that we have the reserves, that we have this money set aside. As far as tax savings and stuff like that, the first one that I'm going to put out there is retirement. Right? Simple IRA, traditional IRA, 401k. If you do not have any sort of retirement set up, don't talk to me about tax savings until you get something set up. There's no better deduction out there than a retirement account. And a lot of people, they say, well, hey, my business is my retirement. It's not the case, right? Unless you're going to live very frugally, you need outside investments. And again, if you have the money sitting there, if you don't necessarily need it right now, put it into a retirement account. We're going to get a deduction on it, and it's also going to grow tax deferred. Obviously, buying equipment, buying vehicles and stuff like that is going to be a great write-off. The big thing, though, is are you really buying it because you need it, or are you buying it out just for a write-off, right? And so an $80,000 alignment machine is going to be a great investment if you're doing that many alignments, right? Not only are you going to get a good tax deduction for it, it's going to generate me money in the future. If I have a couple lifts or racks that are causing me issues and need to get replaced, hey, buying those is going to drive business in the future, going to make my technicians more effective. Great investment. Going out and buying an $80,000 F-250 just to save money on taxes is a pretty terrible investment, right? It's the laziest tax strategy I've ever seen. If you need a truck and you have to get it anyways, then great, get a write-off for it. But just doing it for the fact of a write-off is terrible, right? Because we're still out. Let's say that $80,000 truck saves us 20 grand. I'm still out $60,000.
Absolutely.
So if it's going to make you more money, then buy it, write it off. We're going to get the deduction. Or if it's something that is going to make your team more efficient, or it's something that you're going to have to do eventually, then both great strategies to, buy that equipment, buy that asset, and, write it off.
Yeah, no, I love that. So I definitely have heard stories of people like, oh yeah, I got to write it off. So I bought this boat, and it was just like, well, why? Like it's not related to like improving your business in any way. So you just spent cash, and that could have
Yeah,
been
you're still out the money,
yeah,
right?
exactly. That's
People
not
have
gonna
this perception that, oh, it's a write-off. Yeah, but you're writing it off because you paid cash or you're going to pay cash for this as well.
yeah, or they're like, yeah, you got paid to me rather than paid to the government, but it's
Yeah.
like there's still a good chunk that you wasted there.
There's a difference in there,
Yeah,
right? Yeah, we're not paying
exactly.
100% tax rates
Yeah,
here.
yeah,
Yeah.
absolutely. Awesome. And so kind of on a different segue, I wanted to talk a little bit about some of the fixed expenses, but more in particular, marketing, and sort of what people should budget for marketing. I know yes, we have a background in marketing, but it's a common question that people are always unsure of what they should do, what they can do. And so I would love to hear your take in terms of what people should be looking at and some of the successful companies, what they're doing in terms of marketing budget.
Cool. So yeah, you and I were laughing about this before. You're like, Hunt, you're not allowed to say it depends, right? But it really does. It depends on what you're doing. But as a general rule of thumb, when I look at advertising, the general range that I see people spending is about 3 to 6% of their sales. And so all the stuff that we talk about here, I'm never going to talk about dollars. I'm always going to talk about percentage because that's the same for a shop doing $100,000 a month or 300,000. So 3 to 6% of your sales is a good target. But even more so, it needs to match up with what you're trying to do here, right? And so if I have someone that's spending 6% of their sales on advertising, and I talk to them and they have more work than they know what to do with, they're turning people away, their backlog a month or two, then I would probably say, why are you spending all that money just to turn people away, right? You're filling up capacity that you don't have, and we're really throwing a lot of good money, right? Free plug here for you, Kelsey. It's like, hey, you're paying Kelsey. Kelsey's driving you leads just for you to say, we can't take you. Right. Same flip side is I see people that are spending 1% of their sales and complain to me that they don't have any cars, that they're slow. Well, of course you are. You are only spending a very slim amount of money on advertising. And then the bigger thing here too is sometimes people are a little bit too quick to make decisions on this stuff.
Yes.
Advertising has a lead time, whether it's a lead up or a lead out. Right? If you get an advertiser, no matter if it's you, if it's Google, if it's Facebook, if it's radio, TV, you're probably not going to see any effect on it in the first week, right? Unless you have direct action like text messaging and stuff like that, you can. Most of this stuff takes a couple months. The same flip side, though, is if you turn some stuff off, you probably will not see a difference in the first week, maybe in the first month. But after a couple months, if you turn some of this stuff off, you're really going to start to see the issues on it. And so big thing there is make sure that your advertising budget matches what you're trying to do here. In practice, usually what I see for most of my shops is we average around 3 to 3.5% on advertising. About half of my shops are spending 5 to 6% on advertising on an annual basis. And the other half of my clients are legacy businesses that always have more work than they know what to do with. And so they spend virtually nothing, or their advertising consists of season tickets and other kind of fringe advertising.
Absolutely. No, that's perfect. And I think the biggest thing that people struggle to wrap their mind around with any type of expense is that it can be percentage based off of their sales comparative to like, wow, look at the size of this ticket item, like that's going to really hurt my business when in reality it's like it can bring X amount of dollars as well. So I think understanding the ROI aspect of that, the lead time, that's all great. In terms of any other fixed expenses that you've seen as a sort of hot topic of like percentage base, is there any other sort of categories that you recognize that people should try to understand a little bit better?
Really, the only other one that is something that is not only a large amount, but something that can be changed and dictated is going to be rent. And so rent expense generally should be 6 to 9% of your sales, right? If you're doing $1 million a year in sales, should be about $60,000 to $90,000. That's generally the sweet spot. Now, a lot of that's dictated on where you are. If you're in Southern California, you're just laughing at that comment because you're never going to get close there, right? Pacific Northwest is very expensive. DC metro area, you got some pretty expensive spots as well there too. And so if I look at it, again, it's not just as easy as saying, all right, what's your percentage? All right, that's what it is. Let's say that I'm looking at a shop and they're in somewhere that's not a super expensive area. And I look at it and I say, all right, your sales or your rent is 15% of your sales. Then what that tells me is you better be about doubling your sales, or this location has to have the capacity that you could double your sales.
Mm-hmm.
And that means that, yeah, it's going to be tight right now, because if you're about 10% above the average, then that's coming out of your profit.
Yep.
You just have a very expensive place to do business, and you need to be able to grow that business so that that does come back in line. The other flip side of it is I have some people that are paying 2% of their sales to rent. They're just in a very inexpensive area, very cheap, below market value rent. And if that's the case, then hey, maybe 20% is not a realistic target. Maybe you could even do 25 or 30% because your overhead is that cheap. But generally, if you look at this, 6 to 9% is going to be the sweet spot. If you're sitting here right now and you're at 15% of sales on rent, and you don't think that you can really grow this business, then you need to make it up other places. Right? All of my clients that are in Southern California and stuff like this that have very expensive cost of living, they're doing better than 50% on gross profit, because that's how they're making this up. Hey, I know my expenses are high, but I'm going to be very profitable. My labor rates and my parts matrix have to be high enough to offset that stuff. Yeah. So if you're going to be losing somewhere, you better be winning somewhere else to kind of offset that.
Absolutely. I love that. Yeah. Just, again, it comes down to just really looking at those numbers, though. People just need to remember, you need to look at that aspect to truly understand what can be manipulated and what can be a strength for your shop. Because again, it will definitely vary by location. But then now, speaking of locations, now we're talking, there's a lot of shops that are like, have a really successful first shop, but now they don't know when to make the jump to having another. Like, are there a certain metric, certain amount maybe that should be saved that you consider, yep, this is the sweet spot to then be able to start considering another location?
Not really. I mean, I would say it's more from a mental aspect of things. Okay. You know, if you're asking, well, I think arguably no one's really ready to do the second location. A lot of people find out after they open their second, third, fourth location, right? Yep. That there's a lot more, you know, behind the scenes of what really is demanded. My biggest thing on a second location is if you're still working on your first location, you're still fine tuning it, probably not ready for a second location. Because whatever you've done or haven't done your first location, once you have another location, all of your time and energy is going to be focused on that one, right? And so a lot of people, I feel like, are trying to open a second location before they've really mastered their first. If you don't have the process and procedures in place, if you're not following those process and procedures, how are you ever going to duplicate that to another location? Yep. You know, as far as cash reserves and stuff like that, yeah, I mean, it really depends on size, scope, and stuff like that. You know, you need to do a projection. You need to see what this is going to look like and be conservative about it. If you're taking over an existing business and the business is already profitable, then theoretically you don't need a ton of cash to do that, because it should be cash flow positive, you know, other than the loan payment that you have on the deal. Yep. If you're starting a location from scratch or taking over an abandoned lease or something like that, then realistically, you're probably going to burn cash for 6 to 9 months. You need to not only make sure you have enough to get in the door, get this thing outfitted, but also expect, hey, this is going to take my money for the next 6 to 9 months. And I need to make sure that I'm capitalized enough that I'm not going to be panicking or making impulse decisions just based on cash flow.
Yeah, no, definitely. I love
that.
Not
generally something where you say you have too much cash. I'll say that.
Yeah.
The more cash you have, the easier it's going to be to sleep, the easier it is going to be able to, you know, run your business and make decisions.
Yep. Cash is definitely going to be king when it comes to that. So yeah, you have provided some amazing information for us today. Thank you so much. I would just love to hear maybe some influential books that can maybe help some owners when it comes to this that you would highly recommend.
So can I do a shameless plug for my own book here?
Absolutely.
Yeah. So I wrote a book called Your Perfect Shop. What it really is it's a stream of consciousness of all the stuff that I've talked about over the years. But essentially, chapter 1 starts with starting your business. How should you set this up? For most people, it's going to be redundant because you already have the business set up, but maybe a good insight to opening up another location or making sure that you've done stuff correctly. And then it goes through 13 chapters, the final chapter being how do we value, how do we sell a business, and how do we move on? And so really it doesn't get into the nitty gritty details, very easy read on it, but probably just a lot of basic information that some people know and other things might be kind of cool for them. So that's Your Perfect Shop. You can get it on Amazon. We got a Kindle audiobook version if you don't want to read, just want to listen to it. And if you're cheap and you just want a free PDF of it, if you go to parmelis.com, you can actually download a free PDF copy of that as well.
That's super sweet. Well, yeah, I'll definitely make sure that, and we'll throw that in the links here in the description as well. So I mean, please feel free to grab Hunt's book, because I'm sure there'll be a lot of good nuggets in there on top of what he was able to share with us today. And so is there any last bit of wisdom that maybe you can provide to shop owners that before we let you go here?
So my big thing here is, you cannot be the perfect shop owner. You cannot maximize the performance of your shop, no matter how many locations you have, if you don't understand the finances.
Mhm.
You don't need to be an expert on it, but you need to be dangerous. Dangerous is going to allow you to analyze trends, going to allow you to look at trends, going to allow you to ask questions to be able to drive your business in the right direction. Also, being involved in your finances is going to secure your future, because if you're involved in your finances, we don't see as much fraud, theft, embezzlement, stuff like that. So just try and learn, right? I know people don't like to do stuff that they're not good at, but how can you ever improve if you don't try and start on it? Now, this is not rocket science. This is accounting 101. This is very basic on it. And given the right guidance, given the right tools and the right setup on this is something that any shop owner can be dangerous on. Maybe not an expert, but understand a little bit more about their business.
Awesome. Be dangerous. I love it. So if people want to reach out to you, where can they find you? How can they reach out to you?
Parmelis.com, not only going to have links to the book, all kinds of stuff like that, also be able to contact me right through their phone number and all that good stuff.
Perfect. All right. Well, thank you so much, Hunt, for your time today. Thank you those who have listened. Please, if you're not subscribed, please subscribe to the channel below. But we'll talk to you guys again next time. Thanks.